Gold did not surge because the headline screamed panic, and silver did not follow for drama on demand. Metals moved because a quieter signal changed the math underneath every serious portfolio decision. When the news hit, most people watched the story, but markets watched the plumbing behind the curtain. The real driver was the cost of holding cash, not the emotion of the moment flashing on your screen. That cost hides in real yields, funding stress, and the dollar's mood at the edges of global trade. Miss that, and you will keep chasing headlines and arriving after the move is already fully priced. The trick is spotting what shifted before the crowd realized there was even a story worth chasing. So let's decode what actually pulled the trigger in plain professor language you can act on today. Think of gold as the price of doubting paper promises, plus the price of waiting with real patience. When cash pays well after inflation, waiting feels safe, and gold loses urgency almost immediately. When cash pays poorly after inflation, waiting feels risky, and gold looks like calm shelter again. The headline can be loud, but it only matters if it changes that waiting trade at the margin. Many headlines sound market moving, yet they barely touch real rates where real decisions happen. A central bank speech can feel historic, while real yields barely blink and metals barely notice. A crisis can dominate screens, while the dollar quietly tightens in the background anyway. Metals respond to that background, like a compass responds to a hidden magnet under the table. Here is the smaller detail most traders ignore: the shift in real yields, not nominal yields. Nominal yields can rise and gold can rise too, if inflation expectations rise faster than yields. Nominal yields can fall and gold can fall too, if inflation fear fades even faster than yields. Real yields are what matter, because they are what you truly earn by sitting in cash and waiting. Watch the inflation-protected bond market, and you will see the story underneath the headlines. When investors crowd into inflation protection, real yields sink and metals suddenly breathe easier. When that crowd exits, real yields lift and metals feel gravity return with no warning bell. Now add another quiet force: dollar liquidity, the fuel that keeps global trade moving smoothly. A stronger dollar often means tighter global conditions, even without dramatic breaking headlines. Tight conditions force selling, and metals can drop, even while fear is rising across markets. Loose conditions invite risk-taking, and metals can climb even when news feels strangely calm. This is why metals sometimes move opposite the narrative people repeat with total confidence. The market is not voting on the headline, it is repricing the cost of insurance in real time. Gold is insurance against purchasing power loss and policy mistakes that build quietly over time. Insurance gets cheaper when trust rises, and it gets expensive when trust starts to crack. That crack can start with a tiny change in funding markets that few people bother to read daily. Look at repo stress, swap spreads, and credit strain as early warning lights for cash pressure. They tell you whether cash is becoming scarce or abundant in the real financial system right now. When cash gets scarce, leverage unwinds, and everything that is liquid gets sold with urgency. That includes metals, not because gold failed, but because margin calls do not care about belief. Then, as stress peaks, real yields can roll over and gold can reverse hard upward without mercy. That reversal feels mysterious unless you track the small detail that led the move all along. Now think about silver, which acts like a hybrid of metal money and a key industrial input. Silver cares about growth expectations and manufacturing mood more than gold usually does. So silver can lag when the move is pure fear, and lead when the move is reflationary and growth holds. The headline may describe fear, but the smaller detail decides which metal earns the real bid. If real yields fall while growth holds, silver often has room to catch up with real conviction. If real yields fall because growth is breaking, gold tends to look cleaner and steadier. This is why reading a loan chart is not enough, even if it looks perfectly simple initially. You need a dashboard mindset, like a professor grading the market's logic with daily rigor. Start with real yields, then the dollar, then credit stress, then positioning in futures. Positioning matters because metals can be overcrowded even when the macro looks undeniably bullish. When everyone is already long, the next buyer is hard to find, and rallies lose lift quickly. When everyone is already short, a spark can cause a squeeze that looks like pure magic. That spark is often a tiny shift in real yields that flips the carry trade in an instant. Carry is the hidden rent you pay to hold a non-yielding asset like gold through time, and rent keeps changing. When carry rises, gold must compensate by rising faster, or it gets sold with cold discipline. When carry falls, gold can rise on steady demand without needing a dramatic story to justify it. Now notice how headlines mislead by focusing on the start of the move, not the engine beneath it. By the time the headline is trending, the bond market has often already decided in silence. Bond traders often move early because they trade policy, growth, and inflation as prices, not opinions. Metals follow that decision with a lag, and social media follows later with confident explanations. So if you want an edge, stop asking what happened and ask what conditions just changed underneath. Did real yields soften because inflation expectations climbed, or because growth weakened abruptly? Did the dollar loosen because risk appetite improved, or because policy got boxed in unexpectedly? Did funding ease because collateral became abundant, or because fear simply cooled off for a while? Those answers change how durable the metal move is likely to be in the sessions ahead. A durable move is supported by a trend in real yields and a stable liquidity backdrop. A fragile move is powered by a headline spike that fades when the screen goes quiet again. Here's a practical way to read the next move without guessing the narrative each day. When gold jumps, check whether real yields dropped at the same time or earlier in bonds. If they did, the move has a foundation because the opportunity cost just fell for holders. If they did not, be cautious, because the rally may be pure positioning stress in disguise. Then check the dollar's trend, because metals struggle when the dollar tightens its grip. A gentler dollar can let metals breathe, even if bond yields are not collapsing at all. Next, glance at credit spreads, because widening stress can force liquidation selling quickly. If stress is rising fast, metals can dip early and surge later, like a spring released. Now bring in the physical market, where premiums signal real demand beyond futures flows. When physical buyers step in, dips get absorbed and rallies stop looking artificial in real time. When premiums fade, paper flows dominate and reversals become more violent and sudden. This is the part the big headline never tells you because it is not built for drama. Yet it is the part that keeps professionals on the right side of the trade for years. The goal is not to predict news, but to understand incentives and reflexes in the system. Metals are not moved by stories. They are moved by the price of time and trust set in markets. Time is real yields and trust is liquidity. And both can change quietly overnight without warning signs. So next time a headline tries to explain a metal move in a sentence, pause and test it. Ask what happened in real yields, in the dollar, and in funding before you react with conviction. That pause is where discipline lives, and discipline is what beats excitement long term. You do not need to be faster than everyone. You need to be earlier than the story itself. And you get earlier by listening to the smaller detail that markets whisper before they shout. If you do that, gold and silver stop feeling random and start feeling readable again. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention. Finally, the headline becomes background noise, and the real signal becomes clear for anyone paying attention.